Good evening, guys. How are you doing? Good evening.
Hi, Prof. How are you?
Hey, how are you?
I'm good, thank you.
Perfect, perfect. So you're still, okay, so you're still in South Africa?
Yes, Prof. I'm still in South Africa.
Wow. What time is it? What time is it there?
It's 3:30 in the morning.
Oh, wow. Hey, guys, how are you? Good evening. Okay, so I think we can start. There's one missing, but I think that's okay. We can start. Okay, guys, so we have gone into the intuition of all what is depreciation, appreciation, how this affects individuals, investments, etc., etc., etc. Okay, so we're going to continue now. We're going to do a small mathematics here just to get in an understanding of how this works, and then we're going to do some statistics just to focus more on how we manage risk in global financial markets. Okay. So for many of you, these mathematics are going to be very simple because we have already done them, but I need to do at least one class of catch up for everyone. Okay. Let me share my screen.
Sorry, Professor, I just joined. Did you say we're going over review material?
Oh, no. Yes, exactly. So what we're going to do now is a very simple mathematics. They're going to help us understand what comes next. And many of your friends have already done this. So it's going to be kind of repetitive for them, but it's going to be good for all the team to understand the basics, okay? Okay, so let's do a quick review, and then I will focus more on the part that on mathematics, financial mathematics can help us more on understanding what we're doing. Okay, let's do a brief, let's do financial mathematics. You know, and guys, everything starts with the cash flow. Now, and the components of a cash flow, guys, are always like that. So we always going to have the following components. This is going to be an outflow. Every time that I have something down, it's an outflow. So money is getting out from you. Of course, we have an inflow. So money is coming for you. We are going to have time. So this is going to be my 1, my 2, my 3, and my 4 is always going to be an interest rate. The interest rate, I will call it I. Well, the same happens here, but this is in the opposite way. I have my inflow first, then I have an outflow, then I have time, and of course, I also have an interest rate. Now, the names of these cash flows, guys, differ. In this one here is called an investment cash flow. Why is it called investment? Because you put money first, you invest first, and then you hope to get money in the future. And this one here is financing cash flow, because you receive money first and you need to pay back. Right? Now, the other thing is that we need to do is interest versus interest rate. So interest I will call I, and interest rate I will call it small I. Now imagine, guys, the following cash flow. I have 100 and I have 110. And assume that this is one period. Can be 1 month, can be 1 year, can be whatever, one period. So what is my interest of this transaction? The interest, guys, let me call this is C1, cash flow in period 1. And this one, let me call it C0, cash flow at period 0. Okay, so this is my period 0. So I is always going to be C1 minus C0, simply the difference of cash flow. So my interest is going to be 110 minus 100, so my interest equals 10. Now, what is my interest rate? My interest rate is always future minus present over present. So in our example, I is going to be 110 minus 100 over 100. So this equals 0.1, that is the same as 10%. Got it? So interest rate is a percentage and interest is a dollar number. Ready? Okay, so the third thing that we need to learn is something that's called compounding interest rate. Okay, compounding interest rate, guys, implies simply that interest on interest. So basically what you earn gets into the principal and gets more interest. Okay, so how this works. If you can follow me, guys, for a minute, and once you understand this part here, it's going to be extremely simple. So let's assume that I have the following. I have n periods, okay? So we have n periods, guys. And then assume that I have a C0. And then I have n periods, and then I will arrive to Cn. And assume that per period, the interest is I. Okay, so tell me one thing, guys. What is the interest at time 0? Well, first of all, this is going to go here. Okay, in the future, what is that? The interest is going to be my I times C0. Do you agree? Guys, you agree with me?
Yes.
Okay, perfect. So what is the final amount of money? How much I have at the end of this period?
I times C0 plus C0.
Okay, yes, but the thing is that I will have here C0, my initial money. This one here is my interest, correct? Plus my interest. So basically we'll have C0 plus I plus C0, common factor C0, 1 plus I. So this is the amount of money I have at the end of period 1. Everyone is with me? Guys, are you with me? Perfect. So let's go to the second period, and then you're going to understand how this works. Tell me what is the interest at this period. The interest is going to be I of all the money that I have at that period. I times C0, 1 plus I. Agree with me? So what is the final amount of money that I have at C1? And so this is C1. How much money do I have at period 2? It's going to be what I had at period, this is period 1. Is what I had at period 1, C0, 1 plus I, so this guy, plus the interest, I times C0, 1 plus I. So if I do some calculations, guys, it's going to be common factor is C0, 1 plus I times 1 plus I. So at the end of the day, C2 is going to be equal to C0, 1 plus I squared. You agree? So let me change the color here. So C1 is this one. C2 is this one. How do you think, guys, is going to be Cn? So this value here. Cn is going to be equal to what? Take a look. Here's a 1.
C0 times 1 plus I to the power n.
Exactly. This is going to be one of the famous formulas, guys, that we're going to use all the time. Okay, copy, 1 minute. Now there's some notation. Cn Cn equals C0, 1 plus I to the n. And tell me, is it right that this is true? This is true, right? Agree with me, guys? Okay, so this is the formula that we're going to use the most. What is C0, guys? It's something that we call as present value. What is Cn? Future value. And what is 1 over 1 plus I? So all this ratio here is a discount factor. Yeah, sorry, discount factor. Yes, that's okay. And I alone is the discount rate. Ready? Okay, so let's do some exercises. 1 minute, guys, to everyone copy. Okay, can we move? Okay, so let's do some examples. Okay, so let's do, imagine guys, that you have 500, 4 periods, and you want to know what is Cn. Imagine that for each period is a 1%. Okay, so find Cn. Almost the same. But now I have 1%, 2%, 2%, 3%. Where are you guys? Which question? What question? Which question are you working on now, guys? Done? Okay, 2 more minutes for everyone to catch up. Okay, do it, guys. One more minute, guys. Ready? Okay, so you help me, okay? The first one is very simple, right? This is simply 500, move 4 times to the future is going to be 500 times 1.01 to the power 4, correct? So this equals what?
520.3.
520.3. Someone can confirm this number.
Yeah, confirmed.
Perfect, thank you. Okay, so now how do we do when we have different interest rates? Okay, so we need to do step by step, correct? So first I move this to here, it's going to be 500 times 1.01. So this is my new capital. Then I move these 2 periods at 2%. So it's going to be times 1.02 power 2, correct? And then finally, I move this one additional period that is at the 1.31 period. Make sense to everyone? And so this is equal to what? Someone?
541.
Sharp?
0.1.
0.1. So guys, let's do always 2 decimals, okay? So just to be sure. Someone to confirm? Confirm. Yep. Perfect. Thank you. Okay, this one here is a little more complex, but we can use the technique that we have always used. Okay, so let's move first the 500 to this position. Okay, so this is going to be 500 times 1.01 to the power 3, correct? Then when the 1,000 enters, so this is my capital at period 3. When the 1,000 enters the equation, this is going to be my new capital. Agree with me? And then I move this capital 2 periods. So I will move this by 1.01 power 2. Then I enter 400 more. So this is the amount of money I have at period 5, correct? And then I move this one more period, multiplying by 1.01. And that's it. Or guys, if you want, you can move the 500 to period 6, 1,000 to period 6, and 400 to period 6. It's exactly the same. Okay? Or you tell me what is this value? Someone?
I got 1965.
1965.
965.06.
06. Someone to confirm? Perfect, confirm. So, or guys, the other one, if you don't understand this part here, you can do 500. You move this to the future, 1.01 to the power 6. Okay? Plus 1,000, 1.01 to the power 3, and plus 400 times 1.01. Agree or not? Can you verify that? Some of you can you check? Yep, perfect. the last one is a discount. Okay, so remember guys, the following. If you go from the present to the future, this is called compounding. And if you go from the future to the present, this is called discounting. Okay, these are the names. So that last example, guys, is an example of discounting. So what I need to do is I need to bring my $2,000. Well, there's change in interest rate. So if I move the $2,000 up to here, this is going to be 2,000. Discounting is down 1.02 to the power 2, correct, guys? 1 period, 2 periods. Then from here, I discount these 2 more periods. At what rate? At 1.1, 2 periods. And then we get, what do we get? What is this number?
1,884.46.
0.46. Someone can confirm?
Confirm.
Confirm. Perfect. Okay, copy just to be sure that you get these numbers. One minute and then we can move to the next example, to the next part. Okay. So now let's go in time transformations. So guys, assume that we have the following. We have C0. We have Cn. And then I divide this into small pieces. And in each one, we have I1. Right? I1 in each of these. And also, I know that the interest rate for the full period is called I2. Now, if you follow me for a minute, guys. I know the following. I2, how do you compute I2? Forget about the I1s. How do I compute I2? Guys, how do you compute I2?
I think Cn minus
That's
C0
it. Over
divided by
C0.
C0.
Perfect. No doubts about this, guys. No doubts. It's like that. Now, how do I compute Cn using I1s, using these small periods? It's going to be C0, 1 plus I1 to the power n, correct? Okay, so what I will call, this is 1, this is 2. So 2 in 1. I have that I2 is going to be equal to C0, 1 plus I1 to the n minus C0 over C0. So all the C0s cancel out, and then I2 equals 1 plus I1 to the power n minus 1. And the only thing that you need to remember always, guys, is that n n, this n here, is going to be always equal to the period of I2, so this guy, divided by period of interest rate 1. So this one here. Okay, so the best way to understand this is doing an example. Copy, 1 minute. Okay, so let's assume the following, guys. I have the interest rate for 1 year equals 10%. Okay, so my question is, what is the interest rate for 1 month? Follow me, let's do a couple of exercises and then you do more. So this is going to be equal to 1.1, the rate that I know, 1 plus 10%, 1.1, to the power of something minus 1, correct? If I apply my formula. What I write up, remember this goes up, so I write 1 month here, and the period of this one here goes down. What I write here? This rate corresponds to what? 1 year, right? But I'm talking about months, so I need to transform 1 year in 1 month in months. So this is going to be divided by 12 months. And that's your rate. So 10% annual is equal to, if you can help me guys, 1.1 to the power 1 over 12 minus 1.
Point 00797.
Someone to confirm? Guys, I need you to confirm so when you review this one here, you know that you get these numbers. Confirm? Perfect. Okay, so now you do the following. I want you to tell me what is the 15 days. Oh, we have a convention here. 1 month equals 30 days. 1 year equals 360 days. Okay, so these are the normal convention we're going to be using. So what is 15 days? What is 6 months? What is a 2 year equal to? Can you do that? Okay, guys, you tell me. So this is going to be 1.1 to the power something minus 1. So what I write up?
15 over 360.
Exactly. 15 over 360. Agree? So what is this number?
0.00398.
Someone to confirm?
Confirmed.
Perfect. Thank you. 6 months, this will be 1.1 something minus 1.
Six over 12.
Exactly. And so this equals what?
0.0488.
Okay. Someone to confirm? Confirm. Perfectly. And 1.1 to the power something minus 1. What I do up?
2 over 1.
Yeah, 2 over 1. Never doubt, guys. This one goes here, this one goes down. And the only thing that you need to be careful is in the magnitude. Okay, so months, yeah, days, etc. So what do we get here?
0.21.
Perfect. Okay, easy, right? Okay, so now let's move. Now let's go directly to, I think we can do that. Yeah, I think we can jump here to inflation. In general, guys, what do you understand by inflation? What is inflation?
The loss of value in money over time.
Right, the loss of value of money over time. So this implies increases, general increases, let me increase on prices. Do you agree? Or basically value of money is decreasing. Agree with me, guys? Okay, so now how inflation is created? Why inflation can be created? Well, very common stuff, guys. What happens in the demand side? The demand side can create inflation, yes or no? Can or not?
Yeah.
Yes. So here, what we can argue, demand side, yes. So basically, if demand increases, normally what happens is price increases, okay? However, here what we need to do is be very careful. Okay, let me write demand and supply. No size, side. Basically, if supply increases, prices should decrease. So this is these are the laws, the supply and demand, right? However, guys, remember Keynes. Basically, what he said is, okay, the demand in the economy looks like that. Sorry, the supply. And this supply goes into something that is called the market production or full production. Right? And the demand, of course, is like that. And these events here, guys, not necessarily translate into immediate increase in prices. Why? Because what can happen is that, imagine if your full capacity is very far away, so you're producing at 30% of your factories. If the demand increases, so nothing happens. You continue producing more. Do you agree? You continue producing more. You continue producing more. However, what happens at this level here, guys? Here we are almost at full capacity. Do you agree? So what is the meaning of full capacity is that if demand continues going up, well, in that case, price is going to go up. Got it? So normally the economists say that the economy is hot. So basically, need to cool down the economy. These words are always present in the jargon, economics jargon. The economy is too hot, we need to cool it down, okay? So cool it down means basically, guys, you need to what? You need to avoid full production because immediately you're going to go into inflation, right? So what are the tools that governments use to cool down the economy? Interest rates. They agree? The Fed rates. So what they do when you want to reduce investments or consumption, basically interest rates go up, right? So basically the interest rate going up implies the cost of money increases. So basically this implies that borrowing decreases, and also borrowing influences investments, also can decrease. And so at the end of the day, basically what is going to happen is that prices are going to decrease. Now, in the demand side, guys, who's the big player here? Who are the big players? Governments, right? In the supply side, of course, corporations. But if you put this in the perspective of this class, guys, also imports. You remember that we were saying that if imports grow up, so if you have an open economy, with floating exchange rates, so basically no one controls exchange rates. Governments can try to minimize volatility, but they don't control that. So what happens if imports increases? So basically this implies that supply increases, correct? And if supply increases, what happens? Well, in this case, price decreases. However, if imports decrease, the supply decrease, and prices can go up. This is one possible case of inflation generating processes.
I'm sorry, so that MS is imports?
Yes,
No,
imports.
Okay.
No, imports. Yeah, remember X exports, M imports. However, guys, what can happen is that imports stay constant, but we can still have inflation. So what is the mechanism here? What happens? Guys, what happens? What variable we need to consider here? What can keep, what can create inflation given that MS, that imports are constant?
Supply goes down.
No. I'm saying this it stays constant. So the supply stays constant. So how supply staying constant can increase prices? What variable here? We have been analyzing, guys.
Exchange rate.
Exactly, exchange rate. So depreciation or appreciation?
Depreciation.
Depreciation. So basically, depreciation, remember, guys, more local currency per, let's say, dollar or a foreign currency. Do you agree? Remember, we discussed this last week. That's why governments pay a lot of attention to exchange rates. So they are very, very attentive to exchange rates. More in open market economies and more if the exchange rate is going to be permanent, right? Questions? Make sense to you? Okay. So let's talk now in terms of mathematics, guys. So let me save. Let me open another one. So imagine, guys, that we have the following. Let's say 1, 2, 3. This is quarterly inflation. Okay, 1, 2, 3. So, and these are inflation. So imagine here, guys, I have a 3%, a 2%, a 2.5%, and a 4%, okay, per quarter. I'm exaggerating, but let's assume. Okay, I want you to tell me what is the annual inflation? Then I want you to tell me what is the average quarterly inflation. So remember, pi, guys, is for me inflation. Okay, this is normally the notation for inflation, pi. remember, guys, that inflation is a compounding interest rate. Oops. Inflation, guys, is a compounding interest rate. Ready, guys? So, ¿cómo sería? How is it? How this works? Well, it's like having $1 here, right? I want to know what is my future value of $1, right?
You just 1.03 times 1.02 times
Exactly.
1.025, 1.04, and then
Exactly. So what do you get here?
0.1199 or just 0.12.
0.12%.
No, 0.12 and then 12%.
Oh, 12%. Oh, okay.
Sorry, and then you minus 1 back, right? No, hold on.
What do you mean? Oh, yeah, of course. What I need here. Oh, where's my -1?
Yeah, that's what I did.
Yeah, so it's 0.12, so 12%. Someone to confirm? Perfect, 12%. So this is your annual inflation. Now, if I'm asking you about the average quarterly inflation, guys, most of the people, what they do is, well, you know what? If this is for a year, divide this by 4. This is a mistake, guys. This works if and only if you have simple interest rates, but we have compounding interest rates here, and the way of finding this type of interest rates or inflations is like if I ask you guys, what is the equivalent? 3 months. What is the inflation for 3 months? Okay, so guys, this is a transformation, a time transformation. So this is going to be equal to 1.12, this number here, to the power of something minus 1. So what goes up? What goes up, guys? This is a simple example of time transformation.
3.
Yeah, it goes 3 and down. Remember this one here and down.
12.
12. Guys, this is exactly like the previous examples. Okay, so what do you get here? Someone?
%2.87%.
2.87%. Someone to confirm? Perfect, confirm. Make sense, guys?
Yeah.
Ready? So guys, there is what is current, guys? Current is simply the rate that does not include inflation, right? And normally what happens if I do interest current is going to be equal to the following. So when you sell something, okay, you sell something for two reasons, and you need to have two pieces of, your price should include two pieces. One, the one that preserves the value of your money, you know, and the second that provides you a real interest, a real markup, right? So this implies that the current should be equal to 1 plus pi. So this one allows your money to protect your value. Okay, so you can buy back the product that you have sold. And the second one is the one that gives you a real markup, 1 plus interest rate real minus 1. Okay, so this is the definition of current interest rate. And of course, from here, guys, we can get the famous formula for the real. So it's going to be I current minus 1 divided by 1 plus pi minus 1 equals your real interest rate. This is a current per year.
Professor.
Yes,
So current interest rates, these are another word could be just nominal interest rates.
yes, exactly.
All right.
Yep, current or nominal, the people. Okay, and this is something that happens a lot, guys, in at least in Latin America, happen a lot in Latin American countries. So you have these developing banks, banks for mining, banks for agriculture, banks for whatever you can imagine. And they provide the clients very low interest rates, okay? And these countries at the same time, they were experiencing very high inflation processes. And this is the question. So you're a manager of a bank that offers, for the loans, for its loans, charges basically, no, it's not offered, charges. For its loans, a current of 10%. If the inflation is 12%, first question, could the bank survive? The second question, what should be the break-even current interest rate? The second question, guys, is imagine you sell PCs, okay, in the country that has an inflation, monthly inflation of 5% monthly. Okay, your markup is assumed 10%. And what should be the price? What should your price be at T1? So next month, if P0, so the price at time 0 equals 100. Okay, 3 minutes to do this, guys.
I'm sorry, sir.
Yes.
Just a quick question. So,
Yeah.
in the second equation for real interest rate, in the numerator, is it
Oh,
I
yeah,
current
yeah.
minus?
No. You're completely right. It's plus because the minus 1 goes to the other side positive. So it's 1 plus current. Yeah, indeed, guys. Let me rephrase this one here, okay? Just to be coherent. So it's going to be 1 plus current. It makes sense, no? Because the negative from here moves to the other side, etc. Yeah, thank you.
crimes against Asian Americans in the U.S. As CNN's Ken Law reports, the attacks seem to be on the rise since the pandemic began last year. We want to warn.
Two more minutes, guys, and then we continue. Okay, guys, you tell me, at least the first one. Let's do the first one. So the first one, guys, is telling you the real interest rate, right? Because we have all the pieces of the equation, so we need to compute the real interest rate. Make sense to you guys? Guys, you agree?
Yeah.
Okay, so it should be my real should be equal to 1.1 divided by 1.12 minus 1. So what do you get here? Negative number 1.
Negative 0.01786.
Sorry, 0.01786.
Yep.
So basically 1.786% negative. Agree? Now, guys, there is no way you can survive with a negative interest rate. There is no way. Okay, and that's what happened with these developing banks. They collapsed. Got it? And what is worrisome, guys, is that if you can see the interest rate, just take a look to the current interest rate. It's 10%. It's a lot. However, if you don't consider what is the inflation, you can be destroyed immediately. Okay? Do you understand that? So be very careful, guys, that indeed you cannot survive with a real interest rate that is negative. That's impossible. So you're losing money. Got it? Now, the second question is break even, guys. Current implies simply that I want my real equal to 0, right? I'm break even. So my real interest rate is simply I'm making 0 profits. So this implies that my current should be equal to 1.12, 1 plus 0, I'm just explicit here, minus 1. So equals 12%. Got it? So that's why, guys, it's crucial when you have inflationary processes that your current, at the minimum, should be equal to the inflation. Okay? Okay, guys, so let's do the second one. So you sell PCs in a country with inflation 5% per month. Your markup is 10%. What should be your price at time T1 if PC equals 100? So first of all, let's compute what is my current interest rate. Okay, what should be my current interest rate? Should be 1.05. This protects me against inflation. And I want to have a 1.1 profit minus 1. So this is equal to what, guys?
0.155.
0.155, that is equal to 15.5%. Got it? So based on this number here, guys, what should be your T1 price? Equals your P0 times 1 plus
15.5.
exactly. So this should be 100 times 1.155. So this equals what?
115.5.
115.5. Now, guys, remember that this price, if we do a time series graph, can you follow me for a minute, guys? This is T0 and this is T1. The 5% happened here. Do you agree? Make sense? So what we are doing is we are focusing my price at T1 based on what happened here. However, guys, this price here indeed should protect me for this period here up to term T2. And you know what happens and normally happens when you have this type of hyperinflationary processes? Imagine what happens if this number goes to 10%. What happens if this goes to 10%? It was not 5, it was 10. So what is happening, guys, is that you are going to be losing, right? So what I mean is the following. If it's sorry, this is wrong. When you set prices, no, that's okay. This is forward-looking model. That's okay. So what happens, guys, is that, okay, so imagine that you believe that with 115, if you charge 115, you were able to buy the product. Do you agree? So you take your 10%, and basically, can you tell me this one here? What is this part here? I will divide P1 in two pieces. P1 is going to be equal to P0 105 times 101, correct? This is this part here. I'm just dividing my current. Okay. Now this part here is the one that is supposed to protect me against inflation. So this is what I expect that my price is going to be in the future is going to be $105. Guys, do you follow me? Follow me for a minute. Do you understand? This is my expectation. So this is my expected price at time 1. However, guys, what happens in real life? Inflation is 10%. So this implies that the real price, when you want to buy this back, is not going to be 105, it's going to be 110. So what do you do at the beginning? Well, this part here is going to support this part here. So instead of your 115 and you take 10 for you, you're going to take only 5. Correct? So what happens if in real life, guys, pi goes to 20%? So indeed, the price is going to be 100 times 1.2 is going to be 120. So what happened with you 115? It's not enough anymore. Remember, and that's what I was telling to you. So what is your strategy, guys, in this situation here? There is a lot of uncertainty, and also the inflation goes really, really crazy values. What is your best strategy?
Don't
What is
sell.
exactly? Not sell. Really, because you know, you here, you can survive here. Okay, so you know what? If you believe this is one period, okay, I'm sacrificing my 10 instead of my 10 profit. I will make only 5. That's okay. I can survive one period. But if this goes like this, your basic strategy, guys, is not to sell. So that's why in hyperinflationary processes, like in Venezuela, this year and last year, you go to supermarket, superstores, you don't find anything. Zero. There is nothing. Make sense? And the logic is logic. So it's a business logic. So you don't want to lose money. So the best strategy for you is not to sell. Got it? Make sense? Guys, I need you to understand these concepts, please. Okay, so finally, central banks have a markup equal to 0. And that's true. So central banks don't want to profit. Do you agree? So this implies that the current, and this is an easy question, the current is going to be 1 plus inflation, 1 plus real. So basically having no profit implies this is 0. So at the end of the day, the current is going to be equal to inflation. So this is true for central banks always, guys. So that's why the Fed rates, for example, the level of the Fed rates more or less give you an idea of what is the expected inflation of the government. Okay, so the Fed rate now is around 0.7, so it's very low. What is that? If this law happens, if this simple law happens, so basically they are expecting an inflation around 0.7, 1% maximum. Okay? Even though the goal is 2%, that's what happens. Makes sense? A very simple model can give you an idea of more or less what the government is thinking. Just take a look to the Fed rates. If the Fed rates starts going up, and for example, this is what happened today. So the interest rate start increasing today. So immediately the people say, oh, whoa, wait a second. So there can be a relationship with inflation. Got it? So immediately you can relate these type of things. Okay, questions, guys? I think we are going to stay here because the next step is I need a lot of time to develop the second part. Questions, guys? Next week, we are going to do basically FX, how FX is managed by math. It's very simple. And once we understand all this part here, we're going to go into some statistics, guys, just to create forecasts. So you know what? Because at this point, what we are doing is we are saying, okay, the inflation is going to be 10%. However, we have the tools already now to say, you know what, the inflation is going to be between 6% and 14%, for example. So I will show you how to do this stuff and to create better forecast and better scenario analysis for global financial markets. Make sense? Okay, questions, guys? No questions? Okay, so see you next week, guys. Please, if you have questions, just email me and I normally answer very quickly. Got it?
Thanks. Have a good one.
See you guys. Take care.
Thank you.
See you guys.
Thanks,
Bye-bye.
Professor.
Bye, guys.